Zoom is preparing to live stream. That means it is Value After Hours, 10:30 a.m. on the West Coast, 1:30 p.m. on the East Coast. Jake Taylor and Bill Brewster. As always, what's happening, gents?
What's good, my brothers? And yet
so
little.
much. Yes. Jake, what did you prepare for us today?
Well, I've got a segment on cultural evolution and Chesterton's fence. So we're getting into some deep stuff here.
I heard a thesis that ended in Chesterton's fence the other week. The guy said, sometimes it just is. The moat just is. Ooh. I'm pretty sure that's what Chesterton, right? It wasn't it just like a fence that was in the middle of a field and like it was just there?
Yeah. I mean, it's more generally that reforms of any kind should not be made until the reasoning behind the existing state of affairs is fully understood.
So you can never make a reform. I like it.
Well, you can't just go reforming because you don't understand. Why is this fence here? This is stupid. Let's just tear it down. But it was put up there for a reason originally. And why is that?
Sometimes the world changes, man. Sometimes that reason is no longer valid.
That's true. But I think we often use reasoning, and we'll get into all this, but to jump to a conclusion as to why something's no longer needed, but we actually don't understand why it was originally being used.
Yeah. And what you really need is a jump to conclusions, Matt.
It's like Twister, but
yeah, but you jump to conclusions.
Got a good spread today, fellas. Dubai, Illinois, Bangalore, Townsville, Caribbean, Huntington. What's up, fellas? Good to see everybody. Good global
I don't
spread
even
there.
believe any of those.
Townsville, Queensland must be like
fake news.
3:30 in the morning. Could be earlier than that. I don't know. That's an early start. Good for you.
I jumped into an Aussie space on Twitter. I like listening to the Aussies talk finance.
What was going on?
Was it insightful?
The guy was talking about how he was. I thought it was a really good space. I perceive him to be like 45 or 50, and he started a space for this is on the Twitter machine for those that don't know. Just like for younger people to talk about journaling his thoughts to make sure that his mind was remaining sane in a drawdown. And I thought it was a nice way to give back.
I like that.
Yeah, it was solid.
That's not a moat. This is a moat.
That's right. Let's talk about this fence concept.
Okay. Well, do we have anything else to tease, or
no? We spent all our time on gifts.
I'll tell you what's coming, but we can do JT at first. I got Smead Cap. Don't know much about them, but have this nice piece called "When Quality Fails." That was a good one. Some good lines in here.
Smead, as in Captain Hook's number 2. Is that where it comes
Smead's
from?
Me. Yes, Smead. I think that's right. Yeah, played by Bob Hoskin in the.
I watched that last night. Hook with my.
Oh really?
Yeah,
that's a classic. That's a good.
How young?
Rufio.
How old or young do you think somebody needs to be before you can watch that?
Oh, I think a 7 or 8 year old could watch it real easily.
That's what I was saying. But I got pushback from the fam. Oh, I got to sign for something, and then I'm gonna be right back. But I just got a delivery, and I know I have to sign for it.
Special.
It is a special delivery. I was told. Make sure to sign for this.
Got Brisneyland in the house
FedEx, I would.
Brisneyland. I'll be back at Christmas. Going to be back in Australia for the first time since 2018.
All right, I'll be right back.
Been too long.
Wow, are you doing a world tour? You're going to go see the fans and
just see the family.
Oh, okay.
And maybe I'll do something.
Yeah, do a happy hour or something for the Aussie fans.
Half dozen of the people I know who'll show up. The other thing I've got, Zena came out. We can discuss this while Bill's not here because he won't enjoy this as much. But Pazina came out and they said the value run's not over. It's going to keep on going. So I was relieved to hear that.
From Rich's mouth to God's ears.
It started in September 2020 and it's June 2022, and I think it's still got legs. So I'm happy to hear that.
I did see a chart. I don't know. It might have been Cliff Asness. Maybe not. Something on Twitter that showed that these kind of regime changes could take 10 years. I mean, they take longer, I think, than people often give them credit for.
Yeah, I don't think it's really even got started yet. I think all we've seen is
Just a
both
taste.
run up and get smoked. And value's just kind of been sitting there, but we'll see. I'm going to do the quality thing in a bit. I like this. There's some great lines in here. Hey, value stocks in the house. What's up?
ESG.XLS.
You see how much the Austrian century bond is drawn down?
How much?
Oh, what is it?
It's like 64, 65%.
Oof.
You're going to collect the face value of that, though.
That's duration risk on that 100-year.
Maybe argue about buying it here. That may not make that much. That could make sense.
When's it expire?
All right.
You'll be dead.
Yeah, 21 something.
Oh, it's 100 years from today. It's only just
No,
recently issued.
but I think it was issued in like 2018, right? So 2118, something like that. I mean, it's a long time.
Gee,
Why didn't the US do that?
100-year bonds.
Yeah. I think the appetite might have been there. And if you're gonna have low rates, issue 100-year bonds and go build a
is
bunch
weird,
of
right?
infrastructure.
Why didn't they do that?
I don't know, because we've got jabronis running things. Sorry.
At the time, we had the best businessman in the history of the planet, sir. Just saying. That's, I don't know. I read it from his Twitter account.
I'm gonna have to go back to my journals and see what I was thinking about that at that time.
Fair enough. Anyway, we shall move on.
Okay. Should we crack open some Chesterton's fence?
Yes.
Let's
Okay.
do it.
So this comes a little bit in a roundabout way in that there was this book called The Secret of Our Success, and it was by Joseph Heinrich. And if that name sounds familiar, it's because he's an anthropologist who also wrote another book that I think we've talked about on the show called The Weirdest People in the World. Anyway, this book basically asks the question, it's hypothesized that humans succeeded because we have this raw intelligence. And Heinrich argues that that may actually not be what our success came from. And his evidence that he points to is that European explorers, when they came over to the New World, they're in these foreign lands, and theoretically, they should have been done really well. They had all these advantages of like better technology. It was basically just young men in their prime who came over. They didn't send women and children and elderly.
Men in their 40s, early 40s.
Yeah, and they were selected for hardiness. And then, shut up, Toby. And then, but yet these guys who came over, these Europeans, they ended up starving to death often. And meanwhile, and the hunter-gatherers who were living here already felt like they were living in material abundance. So where's the disconnect? So when these Europeans were forced to hunt and gather, they failed miserably. And I would challenge any of us to, if you want to see how bad we probably are actually at survival, just on using our raw intelligence, would be go try to start a fire outside right now with no implements. Could you actually do it? It turns out it's incredibly difficult to do. If you ever watch Naked and Afraid or any of these other survival shows, without the tools like a lighter or a flamethrower, it's really hard to get fire going. So anyway, so how did these local populations do it? Heinrich argues that it was cultural evolution, a trial and error over long periods of time, and the transmission of what worked to the next generation that actually emerged as to how we survived. These tools and techniques and cooperation and tradition and trading, all of those are how we were able to survive and thrive in an ecology. So you take a European and put them in that same ecology, and they don't thrive because they don't have the cultural adaptation built up for it. So even our digestive system evolved along with us, with our culture. So it turns out that our digestive system is incredibly puny when compared to the rest of animals. Our mouths are the size of squirrel monkeys. Chimps can open their mouths twice as big to eat food than we can. We have really weak jaw muscles. Our stomachs are about 1/3 of the surface area as what you would predict based on our size compared to other apes. And our colons are only 60% of the expected mass. So we have this really underdeveloped digestive system. We're an embarrassment to nature. What's going on here? Well, it turns out that we depend on this thing called predigestion, which is cooking and soaking and chopping and rinsing and boiling. We basically like pre-cook our food to unlock the nutrients. And what happened was that a lot of these European explorers, they had the wrong cooking techniques for that environment. So they were eating plenty, but none of the nutrients were being absorbed because they weren't unlocked because they didn't have the techniques. So first little nugget that we can take and maybe extrapolate back to our world of investing is that I think you have to be careful when you're borrowing other people's ideas through 13Fs or whatever, you're reading their if you don't have the same sort of pre-digestion, the same sort of cooking techniques for an idea that they have, you may not actually unlock the nutrients of that idea. You're just not going to understand how they got there, and you'll never have the same kind of conviction around the idea. All right.
Long bow, but it's a good story.
Okay, that's what we do here. I mean, okay. So next thing is, it turns out our brains come hardwired with some predetermined slots to them. So like language, animals, and plants actually. So looking at, if you notice, like, why is it that when we teach the ABCs, like it's generally taught through animals, like A is for alligator, B is for bear. It's because actually the human mind is pre-wired in a way to recognize fauna and like associate and learn from that quickly. And we're actually maybe not so like we're then naturally drawn to it as well. Like we want to learn about animals when we're kids. Also, same thing with plants. It's a little bit the opposite. Like they did these studies with infants where they'll give them some object and like the kid will put it in their mouth right away, right? Like you guys have kids, you've seen this phenomena play out. But if you give a kid, an infant, a plant, they won't put it in their mouth right away. Like we're pre-wired. And it's because through evolution, like plants had their own evolution where they evolved nettles and poison and toxins and, oils that would cause irritation to not be eaten. And so they, until an infant sees other people eating a certain plant, will they then start to eat it? But before that, they won't. So it's like a cultural learning about what plants are safe to eat.
That is neat.
I think so too. Now, and this applies to other things too as well. Like Westerners, we learn that insects aren't edible as kids typically, but some Asian populations learn that insects are edible and they taste good to them. And it's probable that once your wiring gets set for that, like you're never going to then find an insect to sound like something good that you want to eat if you in your youth were exposed to it or not, right? And so we learn this cultural adaptation really of are insects edible enough. So for all the Davos people who are pushing for us to want to eat insects, you probably want to start now on this population that's just born, because no one's going to find it edible unless you learned when you were a kid.
Don't give them any ideas.
Weren't people arguing for like crickets for a while? Like if you blend them up, they're high in protein.
Yeah,
sure.
You can get cricket bars.
Yeah.
You can go to a cricket bar?
You can get cricket bars.
You can buy a cricket
round
bar.
up crickets into a protein bar, yeah.
Yeah, I guess I'd try that.
You flavor it with enough stuff, it just tastes like the flavor.
Yeah. I've had them before, and I didn't care for it myself, but maybe it's because I didn't grow up eating crickets.
Maybe it's because you just have good taste buds.
I don't know. All right, so the next part that's kind of interesting is there are these native foragers up in Labrador, Canada, and they hunt caribou, and they have to decide where do they want to go. To go try to hunt caribou. And if you went to the same place over and over again, the caribou would start to learn as well that like, oh, don't go here. There's humans here. You're going to get hunted. So the hunt, like there's sort of a matching problem where the hunter wants to match where they're going to be, and the caribou wants to not match wherever the hunter's going to be. So if the hunter showed some bias towards a particular place, then the caribou would start to catch on to that, and then they would be less successful. So what ends up happening is that the best hunting strategy actually involves having some randomization to it. And so the cultures evolve this thing of divination, really, which is they'll take a caribou shoulder blade and they'll put it in the fire, and it will get this like charring and cracks in it. And then they'll take that shoulder blade and use it as a map to figure out like where should they go hunt. That'll tell them where to go hunt. But really what they've evolved is just a random kind of like map generator to make sure that they're more randomized, right? So this is where we get back to Chesterton's finch. Like we could look at that and say logically, that makes no sense. What do you like? There's nothing about a shoulder blade that's going to relate to Canadian geography and how it gets, scarred in the fire. And yet it has this adaptation that is favorable in that it creates a randomization that makes them less predictable. So that's a Chesterton's fence where, you would say like logic says, well, tear that fence down. That doesn't make any sense at all, but it evolved for a reason. Unless we really understand what that reason is, we don't go tearing it down. There's other examples of that with, so the Romans had this thing called augury. And I think that like it involved like often like bird watching to then tell them where are they going to attack and when. So they would use birds as a like a signal from the gods, basically, and what it effectively did was created randomization. So if you were too predictable as an army, that the defense can figure out how to repel, where you're going to be. So it sounds like, well, what the hell would birds have anything to do with leading your army? And yet it had this very useful thing of randomizing. So that to me, like, and then one more of these Fiji women, and actually every taboo that humans have probably has some deeper biological evolutionary reason behind it. And so like Fiji women, it's a taboo for them to eat sharks. And it was because they believed that your child would be born with shark skin if you ate sharks. But what actually was happening was that it turned out that sharks contain these chemicals that would cause birth defects in Fiji babies if the woman ate sharks. And so they got there, but for not any of the right reasons, and which makes me think often about actually position sizing. And I can't help but wonder if maybe like even position sizing is a little bit of taking advantage of the randomness of the world that we really can't predict as much as we think we can. And if you just use randomization in a way via even position sizing, that you give yourself a chance at maybe even better outcomes than when you think that the right reasons for why you're going to really load up on this one idea versus one of the other ones. So there's our veggies for today.
That was good stuff, JT. That was very interesting. What's the book called?
Book's called The Secret of Our Success.
That's good. I like some of those ideas.
And if you don't want to read the whole book, there's a pretty good article that Slate Star Codex did in 2019 on it that goes through some of the high points of it that is probably worth if you want to just take the Cliff Notes version.
There's definitely some risk to following a single strategy, for example, in investing. You can underperform for very long periods of time, get discouraged, get out of the market.
Tell me more.
In a theoretical sense, I'm talking wholly theoretically. Yeah, that strict version of anything, I think, even though ultimately it might succeed over the long run, can have that short run can be very long. It turns out tough to follow.
Yes.
But I like that. I like the randomness too. Just that I think that small random number generator that can be helpful just to push you around from idea to idea.
Yeah, and it's something we've talked about a little bit before in an evolutionary context with Slack in systems and allowing them to explore a little bit outside of an optimization to then find a higher maximum. Because if you don't have enough Slack in a system, it could get stuck in a local maximum that is very suboptimal.
What's the what was the solution? That a little bit of momentum or something like that in that context
for investing Slack?
No, that was that specific example where that was just what was the full story there?
I mean, there's lots of examples of it from evolution of an eye for a for biology, like allowing an eye to evolve would take a lot of slack in a system. I mean, your genes are like that in a big way where they're not particularly optimized for any one environment. They're more a recipe that then gets called upon based on the environmental impacts, which creates the epigenetic phenotype that would survive for that environment.
Some good words there. I hope Google is
I got lost.
Epigenetic phenotype.
Sorry, my own eyes glazed over for a second there.
That's good. Should we move on? I've got.
I don't go in the ocean when there's birds above. If there's birds, there's bait fish. If there's bait fish, there's big fish. If there's big fish, there could be sharks.
All right.
So
that's smart. I don't go in the ocean like further than my knees, basically. That's not true. I used to do a lot more than that, but I don't think I want to keep on trying. So this is SMID cap when quality fails. Some good lines in here. Quality has so captivated the minds of investors because it gives them comfort that the mania we just ended was not 1999. I think this is true from what I've seen. Back then, there were no earnings, no return on capital, and very little cash stacked up on balance sheets. The mania we have today is good balance sheets and good returns on capital with no problems in sight. The only issue is that there are companies before that have found themselves in this same situation as today. It was the Nifty 50 in 1972. This was the creme de la creme of blue chip growth in business in America. Jeremy Siegel argued in his book, Stocks for the Long Run, that investors could have paid the highest prices ever for these securities and still almost beat the market 25 years later because ultimately the quality of the business was so good. They produced higher earnings growth and higher returns on capital than the rest of the S&P 500, but still lost. And then he gives the example, or they give the example of Coca-Cola. And they give the example from the 70s, but you could just as easily give the example from the early 2000s, which I think we saw as well. Just the idea is that, there are multiple different approaches that you can take to the market. You can take momentum. Momentum's a very specific approach. You can take quality and value, and they're measuring different things. Value is literally, as it's defined in the academic literature, as a result of Cliff Asness's work, the quality minus junk thing, which came out, I think it was like 2014 or something like that. His argument was that higher quality balance sheets, higher quality cash flow from earnings, and other little metrics in there leads to better performance. Like it's its own alpha generating thing, quite distinct from whether the things are undervalued or not. And then there's value. And so you can, and I've seen there are strategies out there that I always struggled to sort of fully understand what they were doing, because they weren't value guys at all. They were just quality. They were looking at these other metrics, and it does seem to be quite successful for extended periods of time. But everything has its day. Momentum has its day, and then it has a pretty serious collapse when that cycle ends. Value clearly has serious collapses, and in some theoretical sense, hopefully at some point in the future, it'll have a pretty good run. And quality too. So I think quality really has started underperforming a little bit from what I have seen. It's been similar situation to the one that they were just articulating in that article, and also the one that I talk about a little bit in the early 2000s, where there were some very, very high quality companies that were very dominant in their niche and had all of those other indicia of good quality companies, good balance sheets and good returns on capital and so on. And they just went nowhere for 15 years from the start of 2000 to sort of 2015. And they're all the things that Walmart, GE, all the companies that we would agree were really good businesses. And I think that there's some risk of that happening from here as well in some of these businesses. Although I do, like for everybody else, I look at those top businesses. Like I think Google's undervalued. Microsoft is sort of close. All those top names in the S&P 500. But I do think that there's some risk that we go into an extended period where it won't be quality working. It'll be probably value through this point. Maybe I'm talking my book.
Yeah, I mean, there is something very appealing about the idea that you own this quality business and that it should protect you from whatever vagaries the world throws at you, whether it's inflation or market crashes or economic problems. I mean, the good businesses should theoretically insulate you somewhat, but
you can't overpay. You just can't overpay.
That's the thing. And I'm not entirely sure that competitively advantaged period, which is what's required to earn excess returns on capital, how long those are anymore.
Well, I do think they can be quite long, but I think they're often in things that are just under, like the quality brand middle stand. Those things that like it's a family-owned business that's been owned for generations, and they make something like, I think all of these advantages get eroded over time, but they make a scotch that everybody recognizes the brand of, and they have a limited run every year, and they sell them at the price that they that every year they wake up and they decide how much they're going to charge more than last year, and then they sell them all and they go and do that again the next year. Like, that's a good business. It's probably got a very, very durable moat. There are a few of those around.
I hate these conversations.
Why? What do you object to?
I mean,
too theoretical.
I don't like how they're, I just don't like how they're, look, I mean, the price you pay matters, but like, if you buy dog shit at cheap earnings and then that dog shit has to continue to reinvest and you never see the earnings, like, that's not value. That's just crap. And then, if I think like, something that I've been thinking about a lot is, like these actually, I think in a high interest rate environment, like high ROIC companies should trade at a bigger dispersion, because theoretically they could actually dividend you back cash when you have reinvestment opportunity. But then the problem is a lot of them like buy back their own shares. So I think you should almost look at ROIC as like a weighted average of the reinvestment that is needed to maintain, or the investment that is needed to maintain times, plus the reinvestment that is needed to grow, and then plus, right, these are all weighted, like the weighted free cash flow yield on the buyback. That's how I think is like the most appropriate way to look at the like overall return on capital. Because I just don't, a lot of times I think like, I don't know if the business is, I like buybacks because it prevents management from doing something stupid, but I also think people just like look at a buyback yield and they don't. I mean, look, if you're shrinking your share count by like 2%, it's costing you $1 billion to do it. Like, that's, I don't know. But yeah, I think it all comes down to like what you pay and what something's worth. I don't like the classifications of different stocks.
No, I agree. I'm just sort of teasing them out to talk about it a little bit because, and possibly this is an artifact of the last 2 years that we went through, or the period before then, where like the argument was you basically just had to pick the best business, and then that was the only thing you needed to do. You didn't need to worry about whether what you were paying was sensible in the context of.
I don't think that was actually the argument.
Chris Cerrone multiple times.
Chris Cerrone, who actually wrote the paper of The Art of Not Selling, would not make that argument. People that read the paper that don't understand what the fuck Chris actually means might make that argument. But like, that reminds me of like, I used to study Buffett and think I knew what Buffett said. Turns out I was the idiot. He wasn't. I think good ideas got bastardized.
Yeah, I agree. But I think that's the point that we're trying to make, though. That
good idea taken too far.
Yeah, that just merely being a high quality business isn't enough. Like that you can run that as a strategy. That's an entirely appropriate strategy to run, but it doesn't work all the time, even though it sounds like a very compelling strategy. You do need some combination of both. And probably the error that I have made is just focusing too much on value and not enough on the quality of the business. And I think I've tried to correct that error as we've gone along. Because I think that the thing that Buffett has got working for him is that he's buying very high quality businesses, but he's also paying deep value prices for them. So in the event that you get these long periods of time where you get no mean reversion in the multiple, you're still doing okay because your business is doing well. And
he's buying more Apple today.
Yeah.
And he kind of pitched Amazon at the meeting.
I think Apple looks to me to be the most expensive of those four. I don't know.
It's definitely not deep value prices.
No.
But neither was Precision Cast Parts, and that didn't work out.
Yeah, I mean, sometimes shit doesn't work out.
Sometimes you overpay.
People make mistakes. Individuals make mistakes. I mean, I don't know what the problem. I honestly can't work out what the problem with IBM was. Like, how you could avoid a mistake like IBM. That's what I think about.
Rob knew that. I remember talking to him.
Well, how do you avoid that?
Well, I don't know how you avoid it, but I know how he avoided it. I remember asking him about it, and he was like, if you were in computer engineering and you read the words that were on the page, like to him, they just didn't make sense. Like he was like, this just doesn't make sense what they're trying to do. So
But it was a consulting business, right?
Yeah, but I don't know. I mean, look, I don't know enough to speak on. I suspect Buffett saw a sticky product and bought into some of the reinvestment, but I think he was probably outside of his circle when it came to the reinvestment and what it would generate. I think. I don't know. What the fuck do I know?
Consulting businesses
he's Buffett and I'm an idiot.
There are consulting businesses all over the world. Consulting businesses, for whatever reason, do seem to trade. They do seem to be cheap to what you would think that they would be worth, looking at their returns on invested capital. I don't know why. Maybe it's that argument that I think Buffett has said this too, that like with a bank, half the revenue goes to the employees of the bank. So it's hard to make money. And then they all leave the office at the end of the day. So all of the value disappears.
Yeah. Accenture's been a really good stock.
Definitely true.
It's consistently cheap though, from what or maybe I'm wrong.
Accenture?
Closely Accenture.
I want to say it's like a 30 times free cash flow yield right now.
That's expensive.
What's
Let us see.
Metric for a consulting company, do you think?
Well, it should be.
I'm way off. I'm way off. That's why no one should listen to me. What's 193 divided by 8? Quick.
25.
There you go. Well, actually, here, even looking at the numbers, I'm not right. 198 divided by 8, 696. Yeah, 22. Yeah, that's not crazy expensive. I don't know how much that business grows.
It's foolish though, right? So Buffett's buying Apple here.
I thought he was on the last 13F. Yeah, I thought that came out.
Well, you mean he was congratulating. The thing that we found odd was he was congratulating, or he was highlighting the fact that they had bought back stock, and that Berkshire had increased its ownership in Apple.
I love when he does that.
And we thought that Apple was expensive while he was doing that.
I thought he actually added.
I think he'd rather have buybacks than an Apple car.
Buybacks than an acquisition.
Yeah. Who knows?
Yeah, I thought that he added, but maybe I'm wrong.
Bill, is Apple going to win VR?
I have no idea.
Okay.
When did Buffett actually? So Solo Prosperity says, just looked at the financials for IBM. Revenue decline started in financial year 2012 and continued for 6 years straight. So high ROIC, high ROCE still need growth, even if modest. If you looked at Microsoft the same year, I think that 2011 or 12 was the year that Microsoft's revenues backed off too. I just don't think it's as easy as he did buy more. Apple added 0.43%.
Yeah. There you go. The buff dog loves it.
0.43%. 3.8 million shares in Q1. That's a lot. I was going to say 0.43% is not much, but 3.8 million shares is quite a few.
Well, when you're dealing with his numbers, it's not.
Yeah. Can you imagine?
But I guess that's what I think is so hard about the game. I don't think that, it's. Look, I think value, you get into value traps, growth, you get into growth traps, quality, you get into something that loses its quality. And it all boils down to you thought something was cheap and you paid too much and you got screwed.
That's why you need those caribou shoulders.
You didn't hear growth trap as a phrase for the last 5
years. 100%, dude. We talked about growth traps on the show. I don't know when, because I don't have a photographic memory, but we had a discussion about how growth traps re-rate lower than value traps when value traps crack.
We've talked about growth traps, but I don't think it was I don't think it's been like a pervasive kind of thing on FinTwit anyway. Like value traps has been, to be fair, there've been a few more value traps. I think that there's something to just to tie back in the veggies from earlier. I think there really is something to, I wouldn't say necessarily randomize it, but in retrospect now,
Scrabble bag, that's the trick.
Scrabble bag. Yeah.
Pull the letters out. You got
Davey
yourself
Day
a
Trader.
ticker.
Davey Day Trader knew what he was doing.
He was onto something.
I wonder what Giverny's drawdown has been year to date.
I think fairly modest.
Did you see
that? Because that would be what I would define them as like quality portfolio,
Tiger. Well, what about also Fundsmith, right? What that Tiger International, Tiger Global,
Yeah.
the one that was Tiger Technology, Chase Coleman. So they're down 52% for the year, and that's in their hedged product. In their long only product, it's like 62%.
Yeah. What were they up though?
I don't know,
Well,
but
a
they
lot.
saw
It's half that now.
reported like 5x inflows compared to redemptions, even when you're down 50%.
Like a dip.
Double down.
I mean,
you need some mechanism. Sorry, just to interrupt you. I just want to finish the thought before about that. You need some mechanism and this is the error that I made and JT made too. Sorry, mate. I'm going to bring you in here with me, but
whoa.
You wrote the article, and then I fully understood what you were saying in that article, and I rewrote it and broadcasted it, just saying that it was the worst in 2015. It was the worst opportunity set for value in 25 years, and the reason was that the most overvalued stuff was squashed right down tight with the least overvalued stuff or the cheapest stuff. And if I thought about the natural implication of what that meant was that there were very, very high quality companies trading for the same price as very low quality companies. And in that instance, the best move was to go and buy a whole ton of the high quality companies, even though they might have been optically more expensive than the cheap stuff that was worth paying up for. And I think that anybody who had the foresight to do that had a spectacular 2015 to whatever 2021, something like that. I think the play now is a little bit different because the spread is so wide. I think you want to be in the cheaper stuff because I think that this will be a period of time where it's going to be multiple driven. You're going to need to have a discount in order to get the return. The discount's going to drive the return for a little while. Anyway, that's my prognostication. That's really the only thing that I truly believe that is likely to work over the next sort of decade.
So you would let's say, tying in previous episodes where we talked about where do returns come from, and that's revenue growth, profit margin, dividend, and then multiple, and then share count. Right. You're saying that it's probably going to be more multiple driven, and that will more likely be in value's favor as opposed to quality. And it's going to be harder to maybe win on top line or profit margin.
That's what I think. Yeah, I think profit margin, very, very tough. Top line, hard to predict. The other ones, like dividends, are
pretty steady for that. Yeah,
they are pretty steady, but they're also the yield on them is very low historically.
That's high prices.
I
think it's the same amount of cash coming out. It's
that's
the
fair.
Price is high.
Although I think that the payouts have gone down over time. I think that was 60%.
That's because managers were getting paid on EPS, not on dividend yield. So shrink that share count instead of for a return.
Well, let's be fair. I'd probably prefer they do that.
Depends on how expensive it is.
Yeah, that's fair.
It's not a big Tiger Global dunker.
I don't want to dunk on them. I'm just pointing. That's a big drawdown.
Yeah, it is. I guess I'm more curious as to why people are still allocating, and I haven't seen their internal numbers and what their actual returns have been over a long period of time. So I guess I kind of defer to them. Although I would be pissed if I was an LP and wrote a high water check.
I had a guy in the article. Did you see that?
No, you did.
Yeah, that would. I mean, that.
What was the article?
Oh, wherever I read the story about the Tiger stuff, they had some quote from some guy in there allocated in like November last year.
Oh yeah, so wasn't he like that's an unacceptable drawdown?
Absent a bear market, yeah. I mean,
the other thing though is fuck that guy.
Yeah,
like what you're buying when you buy their stuff.
Chaser.
Yeah, to be fair, like Value did the same thing just like a few years beforehand. So it's not like that would have helped you either.
Well, and we were talking about, we would have conversations last year about Shopify, and I would pull up the free cash flow yield and be like, Jesus, right? I mean, like,
nosebleed.
We can do that. That's not like we're not savants. So like this guy could have looked at their whole portfolio and look, this is the same conversation we've always had. Like, if you're going to own stuff at that valuation, you need to own it. And they may not be wrong. I know that sounds like absolutely ridiculous to say, but if a value stock can go down 50% and you're not wrong yet, then so can Tiger Global's portfolio.
That's true.
you got to go. I mean, it's a long way up and you got to own it.
It's 100% in like 12 to 15%. Elite returns are 12 to 15% a year from here. So that's 7 or 8 years that you're underwater, plus like inflation, like real returns. It's a long way back. It's a decade plus back.
So you're telling me there's a chance?
There is a chance. I mean, it's probably going to, provided they don't shut up shop, because that's always a risk, right? When these big guys pull down as far from their high watermarks,
start a new fund.
All their incentive is gone, and they do the Melvin Capital trick where they just wind up.
Yeah,
because they don't want to dig their way back.
It's pretty gross to do that, and then just go get a new batch of LPs.
You got to respect Monish Pabride. Doug came back, didn't shut up shop, ran it for free for a long period of time.
Yeah, he did do a good job with that. You know, I don't know. I was one of the things that I was doing getting ready for the show is like, I think that the right now the positives are not talked about a lot. So I was reading like Jamie Dimon at the Bernstein conference, and that's kind of a terrifying transcript to read.
Was that the hurricane one?
Yeah, but there's much more in it than the hurricane one. Or like, I don't think, I guess that when I heard that headline, I thought it was kind of hyperbolic, and I still kind of do.
To be fair, he didn't say what has been attributed to him. He said it's a hurricane, but it could be something small, something big. He wasn't saying it's going to be terrible.
Yeah, and he did say a lot. I mean, look,
that's not going to get any
focused
clicks,
on
Toby.
risk. Yeah, that's right.
It's clever though. Maybe he gets the headline where he says hurricane, but if it turns out that he's wrong, he can go and say, actually, I said it could be good or bad.
Yeah, well, so I when I was I'll give you an insight into how I do things. It was past work hours, so I had a Puffco pen and I put a little bit of wax in it and I smoked some of it. Then I started reading Jamie Dimon and I started freaking out. And I was like, oh my God. So then I had to slow myself down. And then I got to thinking, and I talked to Bill Wabufo a little bit, and I got to thinking, like, they just did an investor day. So I don't think Jamie Dimon was actually talking to investors. I think he was talking to policymakers and the Fed more than he was talking to investors at that conference. So I think he was like, I think sometimes the messaging can get crisscrossed if you're reading it as an investor and then you're not considering the audience that they're speaking to. And he did note that the consumer is in good shape. Wells Fargo and Bank of America said the same thing. Goldman's COO is there, and he's like an investment banker. He said that he looks to M&A activity for like indications of CEO confidence, and he's not seeing M&A. I think he said we're seeing it hang in there. Then I was looking at like AAA spreads are like pretty much in line with history. Corporate high yield doesn't look great. But like the 210 spread has widened a bit. Ken Fisher always likes to talk about the 90-day to the 5-year or the 10-year, because that's how like commercial banks actually make money, right? Like borrowing really short and then lending long. That is widened out. You know, so I don't know. There's, you know, and you're starting to see the articles about, you know, too much inventory was in the system. Target just, you know, sort of came out again today and said that they're going to have to mark down inventory a little bit more. Layoffs are starting to come. So, you know, there's a world where this inflationary pressure actually does decline a little. I don't think commodities are going to be the immediate, you know, people aren't going to feel it that way, but on a rate of change basis, you know, like the headline says the Bloomberg Commodities Index hit an all-time high, but if you look at it, like we're starting to get pretty technical on the definition of an all-time high. It's kind of hanging out in a range.
I think Grantham had a comment where he said that they have an in-house index that they have tracked of a commodity pool, and they said that it had declined pretty consistently from whenever they established it, 2000, or maybe it was based on some earlier data than that, through to pretty recently. And he said it declined from 100 on the index down to 30. So that's basically a 70% kind of not loss, but like we became 70% more efficient at pulling the stuff out of the ground.
Technology for the win.
Yeah, which has been the very long run experience of humanity. And there was a kind of blip. I guess it was the chart. You remember the commodity super cycle? Like that was before the tech stuff. It was the commodities. Yeah. That was the early 2000s was all the commodity super cycle that China was going to do all this building. And even in that commodity super cycle, evidently commodities were getting cheaper, I guess, because people were investing in it, and that's what happens. But he said since it bottomed at 30, it's now back to 90 in his most recent thing. So it's tripled in the last sort of 5 years, I think.
So we're back to like 1870 prices or something for.
Well, we're back to at least like early 2000 prices. So maybe it's at an all-time high now. So it's just made a new kind of nominal all-time high.
I find the conversations around this get very heated very quick. Like the second somebody brings up Ukraine, I hear a lot of people be like, oh, it's not Ukraine, it's a supply issue. And it's like, okay, well, maybe it's both, guys. Like maybe, just maybe, both things can be true.
Well, I think what happens is you get the underlying conditions are sown, and then you have a catalyst that brings it all out into the open. And I think that the Ukraine is the catalyst, but the underlying conditions pre-existed.
Yeah, I think that's mostly right. I also, I have no clue how to interpret any data right now. It feels like humans are just like spending in waves. And I think that's what caught Target off guard and Walmart too. Like, I don't know how you forecast. You're looking at last year and you're saying, well, we think it's going to be within this percentage. We all need to get all this shit to the shore really quick. So we got to spend a lot of money. So now you got a whole bunch of high cost inventory. And then all of a sudden, like a herd of cats, or not cats because they spread, but you know what I mean? Like everybody starts traveling.
Everybody on the boat. Everybody on the boat ran to one side.
And now people, not to bring up lumber, but people are like, oh, lumber's crashing. Well, yeah, it is. But look at what happened last year. It kind of happened this all rhymes. Like, so who the hell knows what's going to happen?
It's it's as we were talking about last week, it's very hard to predict because when you look at the last 2 years, you've got 3 years of comps and you've got a normal year in 2019. You've got a shutdown year in 2020. Then you've got like a
crazy stimulus
year in 2021. Yeah. So it's hard to normalize for those three. And I don't know. So with 2022, you look back through that murk and then you got to try and figure out what happens next. That's really, really hard. But
I'm pretty sure Ed Hyman
add that third. Oh, go ahead, Billy.
No, I'm pretty sure Ed Hyman is saying that he's expecting like 2% growth in 2023. So no recession. But I guess you could say, well, if inflation's 8 and you're growing 2, that's a recession. And I saw the misery index is like way high, and that's correlated with inflation, even though financial stress is low. Like, I don't know.
It's very confusing. The data is very, very confusing. What were you saying, JT?
I don't remember. Couldn't have been that good.
The other thing that's hard about it, right, is like the you can point to all the good data today, right? And people are going to be like, well, the shit just hasn't hit the data yet. And it's like, it's definitely a probability. Like, I can't argue against that.
I know what I was going to say, that you have that third body problem too, of what's the fiscal and monetary response to all of this. We've been running crazy deficits already, which you're eventually, I believe that you have to pay the piper someday for that. I don't know when. I don't know if it's us. I don't know if it's the next generation, but
are you sure people aren't right now? Because right now we're running a surplus. The dollar is going up like crazy, and emerging markets are going to die of starvation, and that's actually going to happen. So maybe that's how the piper's paid.
Maybe.
But that seems very unfair. But
imagine a recession here, and we've kind of gotten used to now like direct stimmy payments, which wasn't really as much of a thing before, and we end up with kind of something UBI adjacent, and then how do you normalize anything? Like, you don't know how big the response is going to be. I don't know. Like, it's almost as if you would demand a pretty high bar now to part with your capital because there's so much uncertainty for about what the world's going to look like. And yet it's not really been that dramatically changed.
Yeah. I don't know that it's going to change, but we'll see. It may. I'm more worried about trying to stop inflation that's like 1 to 2 years and crashing the entire economy in the process.
When they run those surveys where they ask people how they feel, like they've just had the lowest reading ever, or the most number of people say that they're unhappy with their situation ever. I'm like, that data runs back through the 70s. Now, either we were just tougher back then and people were like, it's just a flesh wound.
Yeah.
And now, now we're so I think they're not particularly useful, those surveys, but they do sort of show something. And it's that a lot of people are upset. I don't know what the reason for that is. Like, not enough money, everything costs more. That's probably,
everything you need is exploding.
Yeah.
And the only stuff that's actually experiencing deflation is like a bunch of stuff like electronics and maybe home goods or whatever. That's all stuff that people bought last year.
Yeah.
So like everything that's getting cheaper, no one's even buying.
Do you need that 10th TV now?
Yeah. And everybody's spending money. There's like $750 on an airline ticket. And they remember the days that it was like $230. Get to Disney and they just gouge you on every single ride that you go on. Like, and it's happening everywhere.
Other than that, though, how was the play, Mrs. Lincoln?
Well, but then you look at the data and consumer balance sheets are pretty good and spending is pretty good. Like, I mean, deposits, they said, are down from the highs, but like they're not. I mean, this is what I'm saying. I don't know how to interpret this stuff.
It does seem like it's being financed on credit cards, though. I did
starting
see
to be
big spike in credit card use.
Yeah. I think Moynihan said that.
It could have just been me taking the family to New York.
Yeah, I was gonna say this is a personal confession.
travel with 3 kids, like they're just absolute animals. Like my wife and I don't eat during the day, just have that one meal at the end. The kids are always hungry and they never want to pay for anything. You got to pay for everything all the time.
All right,
I got to eat right now.
They never.
Charlie Scharf, Wells Fargo. First of all, today there's no question that the consumer and businesses are still extremely strong. Now the question is, how long will that continue, and do we see chinks in the armor? And I think the answer to those questions is yes. Moynihan, the nice thing is card balances are starting to pick back up. Commercial loans that were sort of leading the pack, balances picked up, and frankly, mortgages balances have tipped over and grown now largely because the payoff rate has come down and new originations are down, but the portfolio is not. So loan growth has been solid, and we expect to have quarter to quarter, loan growth. So that sort of matters, because if aggregate credit is expanding in my worldview, then total money maybe
and we're all rich.
No, but you're not. I mean, a contractionary period is not fun for anybody.
Is that what aggregate credit expanding? That's what that issues people. That's what it indicates. People are borrowing, so they feel.
I think you got to multiply that by money supply, but yeah.
That simply is the money multiplier.
Macro alert.
Moving on. No, I don't know. I like that discussion, but I don't know.
I don't know either. I do know that no one wants to own anything in a world where monetary conditions are getting tighter and fiscal conditions are getting tighter. Everything goes down, I think.
So Buffett's got the best kind of, he's got good data coming in because he's got such
Except for maybe oil. Sorry, Toby.
Just that Buffett's got great data. So what he does with all of that great data is he's buying back Berkshire and buying Apple.
He's buying a shitload of Occidental.
And Oxy, yeah.
And he doesn't appear to be very price conscious on that particular buy.
Yeah.
And think about his I was thinking about this the other day, like the railroad is gonna look so good with high oil prices, right? Because trucking, the efficiency is just, it's night and day difference between a railroad and a truck. And his ability to then move things cheaper competitively is going to just look increasingly outrageous, I think. So you have him long Oxy, bought Chevron. You could argue the railroad is kind of a long play on oil in a way. I think he's thought that this was going to come for a while and that he's been ready for it, if I had to guess.
Energy spiking.
He was talking about inflation again in like 2011 annual meeting. Like he just didn't see how we could have the monetary interventions that we had in that 2008 to 2010 period without there being some repercussions someday. And we've like in the last 3 years have made, when you look at those charts between that time period and now, like it is not even close. Like you could barely even see 2008 on the chart.
I don't know that I think I mean, I don't think I'm not sure that I agree that the monetary, I mean, this is stuff that I really don't know. So if it sounds dumb, it is.
Don't let that slow you down.
I won't. It's a podcast.
You don't need to apologize beforehand because people are going to call you back, call you out after the fact. So.
Yeah, well, that's true.
I
just don't know that the monetary stuff actually creates inflation as much as it creates inequity in society. I think it increased political risk much more than it did inflation. And then I think what I really missed is because I think that so much, I missed that obviously mailing checks to people would be the lighter fluid that sparked the fire.
Don't you think that like just having a whole lot of like there are the tokens to participate in society, if you increase the number of tokens out there substantially, and you can't really do much about the physical things that are out there, but the price of those physical things denominated in those tokens must go up.
No, I don't, because I think that the rich are so rich that they don't spend them; they just hoard them. I think it creates a huge bifurcation in society of those that have a lot of wealth and then those that never see the tokens.
Well, people who have the assets don't care about what number of tokens those assets are denominated in. It's the people who have to use those tokens to live that get hurt. That's the point that I make.
Yeah, well, I think where we would agree is I sort of X education out of this because I think there's a lot of policy errors with education. But I think that's why,
and energy.
Yeah, but I think that's why you see a lot of like the things that people want to do went up in price, and there was deflation everywhere else. I think anything that rich people were doing went up in price a lot, and I think a lot of the reason is they were given the tokens, and other people were not. But
those prices are going up in stuff that people consume a lot, like that the average person consumes a lot of like food and energy. Yeah.
Right. But the big change is now we have mailed a ton of stimulus directly to the people. That's the big change.
So you're saying it's a monetary.
That's what we figured out.
It's a fiscal phenomenon, not a monetary phenomenon.
Yeah. That's kind of what policy. I tell myself.
I think it's very hard. I think it takes on very many different forms. Like you're not allowed to say this. Like inflation doesn't run through asset prices. I don't really understand why that can't be the case. But you can definitely have inflation running through asset prices. You can have inflation running through consumer prices. You can have it running in and this is before all of this got kicked off. The Austrian view on this is that you don't really know where the inflation is going to run. And I think that was true. The inflation did run through asset prices for about a decade. And now, for whatever reason, I don't know what the catalyst could be. And maybe it is just sending out the checks. It is starting to run through the CPI, which is still not that's an underestimation of the real rate of inflation, I think.
I mean, to be fair, I'm pretty sure Russell Napier had said what I said. He just said it like 6 months ago, and my brain was too dumb to realize it when I heard it. But I do fundamentally think like a lot of QE is what caused a lot of populism and a lot of the bifurcation in society. I think it had a lot of negative consequences. Don't get me wrong. I'm just not sure inflation was one of them.
Well, there was no inflation, if you're looking for the CPI definition of inflation until, not no inflation, but it wasn't sort of notable until recently, until the last few years.
Yeah.
And now it's notable. And that does seem to coincide with the monetary stimulus with the stimulus checks.
Yeah. Fiscal
stimulus. This game's easy.
Yeah. It's pretty obvious what to do now. Just
grab your ankles and hope.
What should we do now? What's the answer?
Lower your expectations.
I don't think that's true. I think you should raise your expectations. I think the time to lower your expectations was when everything was super high valuations and all the returns had been pulled forward. I did that too. I think, I don't know, man. I think that there's interesting opportunities out there.
I agree. I think there's cheap stuff out there too. Cheap, good stuff.
I didn't mean from an investment portfolio, although I meant more from like lifestyle for the average person. and things are just going to be more expensive. Like your wallet's just not going to go as far, I don't think, for a while.
Yeah, that may be true. But
let me ask you this: Are you backing off on premium tile from the house that you're building?
no.
Okay.
I mean, we're not. I'm changing some consumption habits, yeah, but the wife is going to build the house that she wants.
She's it's price inelastic.
Well, the thing is, I mean, the real answer is we just bought another house and to avoid rent, and it's more modest than the one that we're building. And if real estate prices are what they are, we'll probably flip the one we're building.
Oh, really?
Yeah.
Mm.
I got a price on everything, man.
That's time, fellas.
Well, we made it against all odds.
Good chat. We'll see everybody next week.